here. So, all right, so Thomas Castelli, he is a tax strategist and real estate investor who helps other real estate investors keep more of their hard-earned dollars in their pockets and out of the governments. He started his investment career investing in multifamily syndication and has since been GP on the syndication of 82 unit apartment community. His real-life real estate investing experience allows him to see eye to eye with investors in ways that an average CPA never could. Does that introduction do you justice?
I believe it does. I believe it does.
Well, not to steal too much of your thunder, but CPAs run the gamut of range of expertise. So it's very important that your CPA understand syndication in real estate. If they're going to understand K1s and basis and cost segregation and how to apply that and not miss any of the tax savings, because they can make huge errors. Just one basis missing from a K1 form not getting applied can lose you a lot of money. So I don't want to steal too much of your thunder, but I want everybody to really pay attention to this and get the most out of it because it's something that's very important. Thomas, are you going to be doing a PowerPoint presentation?
Yes, I will. I have a PowerPoint to share with everybody.
Okay, and I've got the question and answer box up and the chat box. Do you have those? Can you see those on yours?
Yeah, let me just double check. I do have the Q&A box and I do have the chat box.
Okay, excellent.
I'll move that over here.
Excellent. So I will let you take it. However you want to answer questions, a lot of times we'll kind of let them build and I can queue them up at the end. But however you want to do it, it's fine. But I'll let you take it from here and show all the attendees what you have.
All right, here we go. We'll go ahead and get started. Okay, so let me present. All righty, so let me move this out of the way here. Get this onto the screen. All right, so thanks everybody for coming and joining this session. Last time I was here in January, we spoke on tax strategies for multifamily investors, where we kind of went through strategies you'll need to minimize taxes across the entire transaction, as well as other tax issues you'll need to be aware of. However, today we're going to be going basically going to focus on the exit strategies. How can you minimize your taxes when exiting a deal? And to be honest, a lot of these strategies can apply to rental properties of all sizes, whether they be multifamily, single family, and also commercial as well. So just want to kind of give that as a just a little something to think about while we're going through this. All right. So before we jump right into the presentation, I do want to make a disclaimer. This presentation is meant for informational purposes only and should not be construed as tax, legal, or financial or other advice. At the end of the day, what makes giving real estate and tax advice so difficult is because as a real estate investor, we're often investing through a disregarded entity or through a pass-through entity such as a partnership where your share of the property's income and expenses and losses are reported on your individual tax return, where you're taxed based on your personal circumstances. And, we all have different levels of income from different sources, and we're all invested in different things. So not everything will apply to you the same way as it'll apply to somebody else. So really what this presentation is meant to be today is to bring awareness to these strategies so that you could have an intelligent conversation with your CPA or tax advisor on whether or not these strategies make sense for you. So let's just take a look at what we're going to cover today. We're going to cover 6 strategies. We're going to cover tax loss harvesting, using current and suspended passive losses to offset the capital gain from sale, deferring and reducing capital gains through qualified opportunity funds, installment sales, traditional 1031 exchanges and Delaware statutory trusts, Section 721 exchanges, UPREIT transactions. And just going to caveat that here today, the first 3 are going to apply to virtually any type of real estate investor, rental property investor. The bottom 3 more going to apply to people who own real estate directly or part of a small partnership and not necessarily syndications, although you can see 1031 exchanges sometimes done when the GP of a syndication initiates them. So we're going to go ahead and just jump right in. So tax loss harvesting is the first one, probably the most basic strategy here. And it starts off with just the concept that capital gains can be offset by capital losses from other capital assets. These include stocks, bonds, mutual funds, real estate, and so on. And the strategy here is simple. If you have assets that are in a loss position and are unlikely to recover, consider selling these assets in the same year you sell property or when an LP investment liquidates at a gain. And the key here is unlikely to recover. If you have an asset that took a small dip and you think it's likely to return, don't sell off that asset simply to eliminate the capital gain on the sale of another asset. This is truly meant for assets that you're taking a bath on and that are never going to recover. So here's a quick example. You have a property you bought for $1 million, but the major employer in that market has moved and the property is now only worth $700,000. It's unlikely that this market will recover anytime soon. I think of a Detroit situation here. That's kind of what I envision, but I know this can happen in smaller tertiary or secondary markets oftentimes. So think about that here. So you could sell that property and use the $300,000 loss to offset the capital gain from other assets. Alternatively, you could have a loss on a stock. Oftentimes, we might see a client that invested in the stock where it went south and, just sitting on their books, if you will, or in their investment account, their brokerage account. You could sell that asset, you could sell that stock and use the losses to offset the capital gains. So who should use this? Anybody who has capital assets that are in a loss position and unlikely to recover. Can't hammer that home hard enough, unlikely to recover. The pros of using this strategy are, one, you're going to be able to reduce or eliminate your taxable gain from the sale of an investment. You benefit from assets that are unlikely to recover from a loss. And there's no need to worry about future recapture or deferred gains. As we go through some of these strategies, oftentimes they're gonna have something to do with deferring the capital gains tax until later on down the line, which we'll get to in just a second. But in this strategy, you sell the asset, you recognize the loss, you use that loss to offset the gain, and it's really that simple. There's not much else to really to know about there. And by the way, I guess one thing to throw in there: short-term or long-term capital gains. Short-term or long-term capital losses, by the way, can offset each other. The rules there are a little. Basically, what happens is if you have short-term capital gains, it's going to offset your short-term capital losses. If you have short-term capital losses, they're going to offset your short-term capital gains first before offsetting your long-term capital gains, and vice versa. So if that's the situation that you're looking at, you might just want to run it by your CPA. Cons of using this strategy: need capital assets that are in a loss position, unlikely to recover. If you don't have any capital losses, there's nothing you can really do here. The strategy won't really be, viable for you. So before we jump into the rest of the strategies, I do want to give an overview of a tax deferral. Why defer? A lot of times when I present these strategies to our clients or potential prospects, they often say, well, I have to pay the tax eventually. So, why not just pony up the money now? And, that is a valid question. And the real answer to that is really the time value of money and compound interest, and also inflation. So, $1 today. So, inflation normally goes up. Let's just say it goes up 3% a year. Let's just make it easy and say it goes up 3% per year. $1 that you spend, $1 you spend to pay off a debt today is worth more than it would be than if you used it to pay it off, than $1 in the future to pay it off. But more importantly, it really is about that compound interest and having more principal to invest today. So let's just say, for example, you can defer $100,000 of capital gains tax for 10 years, meaning you'd have to pay $100,000 to the government today, but instead you wait 10 years to pay that tax to the government, and instead invest it for an annual return of 8%. That investment will provide an $80,000 return over that 10 years period without taking into account compounding. If you take into account, if that were to compound at 8% per year, meaning each year you get that first $8,000 check, then you have $108,000 and that earns 8%. You're looking at it totaling your total return being $215,892.50. So that's the power of deferral. It's not that you're avoiding the taxes. You're using that money instead to invest that money today and earn a gain on that return, hopefully. you at least, if you're investing it in the right way, you would get a gain. So that's just something to think about as we go through the rest of these strategies. So before we go into this specific strategy, I do have to give another brief overview of passive losses, because the passive loss rules when it comes to real estate are really confusing for a lot of people who aren't a CPA or a tax advisor. And there's often a lot of myths and misconceptions that you have to understand while we do this. So the first one is rental real estate has a non-cash expense called depreciation, often creates a loss for tax purposes. So this is important to understand. If you take a look at a profit and loss statement, your P&L or income statement, you're going to have rental income. You're going to have operating expenses, things like advertising, repairs and maintenance expenses, mortgage interest, legal and professional fees, property management fees. These are real expenses that when you pay for them, the cash goes out of your pocket. But then you have one expense called depreciation that you pay the expense is taking it, but it lowers your taxable income, but not your cash flow. So those other expenses, say the say the repairs and maintenance expenses, for example, those both reduce your taxable income and reduce your cash flow. But depreciation only reduces your cash flow. Only reduces your taxable income, but not the cash flow. And what this does is it often creates a loss for tax purposes. So you're not paying taxes on the rental income, but then these losses can be used in future years, and we're going to walk through that here too. So unless you're a real estate professional, which we're not going to go through today, unless you're a real estate professional for tax purposes, these losses can only offset income from other passive activities. So in other words, other rental income or capital gains from the sale of your real estate. In years when you don't have enough passive income to absorb your passive losses, so in other words, when you have a net passive loss for the year, these losses get suspended and carried forward indefinitely. They never go away until you either have passive income from that activity or substantially sell that activity. In other words, you sell a property. So this strategy, we're going to talk about the second strategy, involves around using these passive losses to offset capital gains. So when you sell a property or an LP investment liquidates at a gain, current and suspended losses can be used to reduce your taxable income. For example, you have $100,000 from your W-2 job, and you sell a property and realize a gain for $50,000. This brings your total taxable income to $150,000. But you also have $50,000 in current and suspended losses from other real estate investments. This $50,000 is now unlocked to offset your capital income, reducing your capital income now to $100,000. Now, something I just want to point out here, current losses are the losses from this year. So if you invest in a property and you have a loss in 2019, that's a current loss. Suspended losses are losses from previous years that couldn't be used and are now suspended and available for use in future years. So this strategy lies in monitoring your current and suspended passive losses. Your suspended losses can be found on Form 8582, Passive Loss Limitations. On that form, you'll be able to see how much losses you have being suspended currently. So in the year you sell property, look at your suspended losses from prior year's tax returns. If they're not enough, or at least, if it's enough, or at least close to the amount of the capital gain, no action is really needed for you. Those passive losses will simply offset the income generated from that capital gain, or the income tax rather from that capital gain. If you don't have enough passive losses to offset the gain, or the gain is significant enough, you have a few options. One, you can buy a property in that same year and use a cost segregation study and 100% bonus depreciation to increase that property's depreciation expense, creating a current passive loss that will hopefully, if you invest properly, invest the right amount to offset the tax from that gain. Or you can invest in a syndication as a limited partner that is using a cost segregation study and 100% bonus depreciation in that same year. So again, you can buy the property directly yourself and apply this strategy, or you can invest as a limited partner in a syndication that's employing this strategy. Now, it's important, if you're going to go with the LP route, you may want to have a conversation with your syndicator or connect your CPA or tax advisor with your syndicator to have the conversation for you on how that general partnership, how the sponsor is going to handle cost segregation. Because not every sponsor uses it. Most sponsors do, not everyone does. So you just want to make sure, you don't want to assume that they're going to use it. You want to make sure if this is the strategy you're trying to implement, that that's being done. You can also invest in other businesses as a limited partner that creates passive losses. Examples include ATM machines, self-storage, fitness centers, laundromats, oil and gas, and so on. Who should use this strategy? Landlords who are not real estate professionals. Real estate professionals can use this strategy, but if you're a real estate professional for tax purposes and you have suspended passive losses, you generally can't unlock them upon sale of a single property because normally you're grouping all of your properties together. So when you sell one property, you're no longer substantially disposing of the entire activity. That's kind of outside of the scope of this. Just know that if you're a landlord, you can use it. If you're an LP investor in syndications, this strategy is available to you. Pros and cons of using these passive losses. You can reduce or eliminate the taxable capital gain from the sale of a passive activity without having to use a 1031 exchange or invest in an opportunity fund. Two strategies we'll talk about later. And the cons are you have to continually invest in new properties or passive activities that have losses in the same year the assets are sold. Now, this is potentially a con. You know, a lot of us as real estate investors, we're looking to grow our capital and keep our money moving. So, for us to invest in another property right after selling another one really isn't a con for a lot of people. But if you're really looking to get out of real estate and you no longer want to invest into real estate, then this is a con for you. The con of using this strategy. So the next one is qualified opportunity funds. Now, this is a very hot topic and very new with the Tax Cuts and Jobs Act. It still has not been finalized. So today we're not going to be discussing the operational side of an opportunity fund. We're not going to be talking about, what you need to set up an opportunity fund, what you need to operate an opportunity fund. Instead, we're going to be taking this simply from the angle of an investor. How can we use this as an exit strategy? All right. So the first thing to understand is that investors can defer the capital gains from the sale of stocks, bonds, mutual funds, real estate, partnership interests, and Section 1231 property when using an opportunity fund. So the way this works is you sell an asset and you will recognize a capital gain. You have 180 days from the sale of that capital asset to invest it in an opportunity fund, much in the same way as you have that 180-day window with 1031 exchanges. The main difference between an opportunity fund and a 1031 exchange on this end to realize is that you only have to invest the capital gains. You do not have to invest the principal. So if you have a capital gain of, let's say, $50,000, but you invested $100,000, you can take that $100,000 back of principal at your initial investment and use it for whatever you want. It really doesn't matter. All you have to do is invest the capital gain. Now, there's some important rules to point out with this timeline, this 180-day window, is that for Section 1231 gains, they must be netted first, and the clock does not start till 1231 or the last day of your tax year. Section 1231 gains are long-term gains, typically something you will see with the sale of a building, for instance. The clock also starts for a partnership. The clock does not start till 1231 either. So for a lot of us here, probably investing through partnerships or selling buildings directly, you're definitely going to want to speak to your CPA on how it's going to work for you, because you may not be able to sell the asset and just simply invest right away. You have to wait till the end of the year to see, if any other buildings you're selling are going to sell at a loss, because they have to be netted together. The gains and loss has to be netted before making this investment. And as we discussed before, only the capital gains portion needs to be invested. Short-term and long-term capital gains are eligible, and they will retain their character. Now, Section 1245 and Section 1250 recapture is not eligible for deferral. So basically, the depreciation recapture tax you're going to have to pay upon sale. So you can defer the gain, the actual gain from sale, but not the depreciation recapture tax. You can invest non-capital gains into the fund, but they will not qualify for the tax benefits They will instead be treated as a separate investment subject to the regular tax rules. And in order to receive any tax benefits from investing in a qualified opportunity fund, it needs to be a qualified opportunity fund. It can't just be invested in an opportunity zone. And the capital asset must be sold to a unrelated party to qualify. So, in other words, you can't sell a building to your brother, to your parents, to your son, to your daughter, and be able to defer the gain. It has to be to a legitimate third party. I guess the way the IRS looks at this is you would still be in control of that asset. So, what are the benefits? What are these benefits really? So if you hold your investment, so in other words, the capital gain in the fund for 5 years, you will receive a 10% stepped up basis in your original investment. So what does that mean? Your basis in the investment starts basically when you make let's just say you took $10,000, $100,000 and invested it into an opportunity fund. Your basis starts out with zero. But after 5 years, your basis increases now 10%. So now you have a 10% basis, which means that your original capital gain was $100,000, but now you will only pay tax on $90,000 of that original gain. Now, if you hold the investment in the fund for 7 years, you'll receive an additional 5% total step up for a total of 15%. So again, if your capital gain was $100,000, you hold it for 7 years, you're now only paying tax on $85,000 of that gain. So you're reduced in this strategy. There's two parts of the strategy. You're deferring your capital gain. So say you have a $100,000 capital gain in 2019. You're investing it into the opportunity fund. You're deferring this capital gain, and then you're also depending on how long you hold it, you are also potentially reducing this capital gain as well. Now, the biggest part of this strategy, I used to say the real gold in here is that if you hold your investment in the opportunity fund for 10 years, the entire gain on sale is exempt from tax. And I want to make the clear distinction. It's not your original capital gain is not exempt from tax. It's the capital gain on the opportunity fund investment itself. So let's just say your original capital gain was $100,000 and you hold it in the investment for 10 years and it appreciates to $150,000. The $50,000 capital gain on the qualified opportunity fund investment is now 100% tax-free. So as you can imagine, this is where the real power of the strategy is. And this is a basic example. If you're going to invest $100,000 over 10 years, chances are your gain is going to be much higher than $50,000. So just think about that. Think about the power of that for a second. Now, there are some rules here. So taxpayers will have to pay. So the way this works is when you defer this gain can be deferred until 2026 or until the point where you sell the investment, whatever comes first. And one of the things to be aware of here is that because this gain will be deferred until 2026, in order to meet that 7-year requirement to get that full 15% benefit, you have to hold it. You have to invest by the end of 2019. You have to invest by December 31st this year. Otherwise, you won't be able to meet that entire 7-year hold. Instead, you'll only be eligible for the 5-year hold, which is the 10% reduction in your original gain, and also the sale in 10 years. So you'll still be eligible for the 10-year and the 5-year benefits. Now, this can be done. You can make these investments in these opportunity funds up until June 30th, 2047, and the eligibility for the 10-year exemption ends on December 31st, 2047. So you have a long time to get that 10-year benefit. These gains are deferred on Form 8949, sales and dispositions of other capital assets. Now, so what are the pros and cons of using this strategy? The first pro is you're deferring and reducing Section 1231 capital gains from the sale of any capital asset, including real estate and partnership interests, and you have the potential to eliminate the capital gain from the sale of the qualified opportunity fund investment itself if it is held for 10 years. The cons of using this strategy is you have to hold this investment for at least 5 to 7 years to see any benefits other than simply deferring the tax for a few years. The second con is Section 1245 property, and basically the depreciation recapture is not eligible for deferral. That's one of the cons. So who should invest in qualified opportunity funds? Direct multifamily investors, although you can, again, any type of rental real estate counts. You can roll your gains over into the fund. Passive investors, if you're a passive investor, you're an LP in a syndicate, you can absolutely use this strategy. Some important items to note here is the qualified opportunity zone and opportunity fund regulations are still in the proposed regulation stage and have yet to be finalized. So be sure to consult with your CPA before making an opportunity fund investment. You definitely don't want to. You definitely want to make sure that you're in compliance with the current regulations at the time, because there's been 2 rounds of proposed regulations that have been released. A lot of accountants and the tax advisors are anticipating the final release, the final regulation to be released this year, but no one knows for certain. It's whenever really the IRS decides to do it. So another thing to note is, due to the potential phantom income, the deferred gain being recognized in 2026, investors will need to have liquidity to pay that capital gain in 2026, regardless of whether or not the investment is sold. So again, you're going to have to recognize the gain on your original investment. So in the example we were using before, that original $100,000 deferred gain in 2026, regardless of whether or not you sell the investment or not. So in other words, you're going to have you're going to have income tax, but you may still be holding your taxes. So there's some financial planning that needs to be done here. You need to be able to make sure that you're going to have the liquidity to pay that tax if you're going to continue to hold the investment in there. And for some people, that's something you're going to be needed to plan very carefully. So the next one we have is installment sales. Installment sales are often called seller or owner financing. And this part of before we just dive right in here, it's important to note that the next 3 strategies we go through are going to be more for the direct investors. While they can be used in a syndicate, it's more rare to see something like that. So an installment sale, again, often called seller owner financing, allows you to sell your property to a buyer and receive payments over a predetermined number of years. This spreads out your capital gains tax over several years and gives you an additional return in the form of interest. Again, with seller financing, you're essentially becoming the bank. You're taking back a note. Instead of having the buyer go to a bank for a loan, you're just directly financing for them. So let's go through an example. Let's say you purchase a property in 2010 for $30,000 and you want to sell it for $110,000 in 2018. Your AGI is $180,000, and this $80,000 capital gain is about to increase your AGI to $260,000, causing you to pay an additional 3.8% in net investment income tax. Your CPA suggests that this property, that you sell this property on an installment sale to avoid this additional 3.8% tax. So what you do, you go out, you find a buyer, and sell them the property for the full $110,000. They put $110,000 down, so they give you $110,000 up front, and they finance the remaining $100,000 over a 10-year period plus 6% interest. So each year, out of $7,273 out of the $10,000 payment will be considered a capital gain, and the other, so you're going to be taxed it's going to be considered capital gain, and then the rest of the $2,727 of your return will be principal. You'll also pay, so that in this example, you'll pay $1,091 in capital gains tax, but no tax on the return of principal. And also, the interest you receive on this investment will also be taxed at your ordinary income tax rate. So that's pretty much pretty much how installment sale works. Is you're not paying the full capital gains tax in the first year, so you're deferring some of that down the line, and you may also be able to reduce tax by missing out on something called the net investment income tax. So what are the pros and cons of using installment sales? that can prevent you from entering into a higher tax bracket in the year of sale, can help you to avoid the 3.8% net investment income tax, and the ability to, it also gives you the ability to charge the buyer interest, which can be a nice source of passive income for you. Sometimes what we see is some of our clients, when they're looking to exit deals and they don't want to be active in real estate anymore, they'll sell it on an installment sale so they have that stream of income from that interest. Some cons. You don't receive all the cash from the sale up front. You may only receive a small amount, for example, the down payment. The entire Section 1245 and 1250 depreciation recapture tax is due on sale and is not spread out over a number of years. So, in other words, your capital gain is spread out, but not your depreciation recapture tax. Another con is if the buyer defaults on the mortgage, you have to foreclose on the property, and you'll be bringing it back active again. Now, something to note here before we move on to the next section, there are variations to the installment sale. There's something called a monetized installment sale and a deferred sales trust, which again use installment sales as a base, but provide different options for how you receive the income. I did not include them in here because they are rather complicated and they're not used very often. But because I want to make you aware of the strategies, if you're taking notes out there, take a look at something called a monetized installment sale and a deferred sales trust are alternatives to installment sales. I did write an article on this. It's on the Real Estate CPA's website, 6 alternative exit strategies when you sell your real estate. So who should use installment sales? Owners of direct real estate who want to spread out their capital gains tax over multiple years and or want a form of passive income. Now, syndicators, while in theory syndicators can use this, I've never seen it done. And because of that, limited partnerships in syndicates cannot use this strategy. So the next one is a traditional 1031 exchange. I'm sure a lot of us are familiar with this already, but we're going to kind of go through what that is. So basically what a 1031 exchange is, it allows you to defer your capital gains tax from the sale of a property by investing the entire sales proceeds, so that's again the principal and the capital gain, into another property, and in a process that's often called trading up. And it's called trading up because you're buying a property, you're hopefully increasing the value of that property, and then when you sell it, the property is now worth more than what you bought it for, and then you're able to purchase a larger property with it. So it's why they also call it trading up. It's important to note here that if you don't use the entire proceeds, part of your gain will be considered taxable boot. So unlike an opportunity fund where all you have to do is invest the gains, here you have to invest the entire gains, both the proceeds, both the capital gain and the original investment principal. 1031 exchange rules. So you have a 45-day identification period starting at closing of the disposed property to identify up to 3 properties to purchase. So that means if you close today, on let's call it June 28th, you have 45 days from today to identify up to 3 properties that you're going to buy. Now, you have a total of 180 days from the date of sale, and this includes the 145-day identification period to close on the new property. So again, if you did the sale today, the sale occurred today, you have from 6/28, 180 days from now, basically 6 months to close on that property. There are also other rules while attempting the 1031 exchange that allow you to identify more than 3 properties. These rules are known as the 200% rule or the 95% rule and the incidental property rule. These rules are going to be beyond the scope of today's presentation. And it's important to point out that if you're going to execute a 1031 exchange, you should be working with a qualified intermediary from the very beginning, meaning from before you sell your property, when you're first considering the exchange, until the time the exchange is over, you need to be working with a qualified intermediary, as well as looping in your CPA or tax advisor. And one piece of recommendation for this, if you're going to be using a 1031 exchange, try your best to start looking at new properties before you sell your original property, so you give yourself some buffer on that 45-day identification window. Pros and cons of using 1031 exchanges. The pros are you're deferring the capital gains tax, which again, deferring it means you have more money to invest today. And because you're deferring the capital gains tax and you're purchasing larger properties, you're getting higher returns. Again, so here's an example. Let's just say an investor purchased a property in 2015 for $1 million, and by 2020, the property appreciates to $1,750,000, and the investor decides to sell. The capital gain from that sale is $750,000, and tax will have to be paid on that capital gain. So the investor would normally have to pay a tax of $112,500 if they're taxed at the 15% rate on that gain. A tax bill that large obviously negatively affects your ability to continue growing your capital. At a 75% loan-to-value ratio, the tax bill of $112,500 reduces your purchasing power by $450,000. So that means if you can defer this tax, you use a 1031 exchange, you're able to buy another $450,000 worth of real estate with the tax that you were originally going to pay. So that's super powerful. And something else here I forgot to put on the pro side is that with a 1031 exchange, you're deferring both the capital gains tax and the depreciation recapture. So there will be no tax recognized on sale if you defer the entire sales amount. If you reinvest the entire sales amount. So just think about that one right there. It's one of the only strategies where you're deferring both. So the two strategies where you're deferring or eliminating both the capital gain and the depreciation recapture is when you're using passive losses or when you're using a 1031 exchange. The cons, it's a very strict timeline for completion. If the deadlines are missed, the capital gains tax must be paid. Again, you have to follow that 45-day window and that 180-day window. That is super important. There really is no flexibility here. Another con is the lower basis in the replacement property leads to lower depreciation expenses to shelter larger income and larger capital gains tax on sale. So when you're using a 1031 exchange, what happens is your basis in the original property remains the same as your basis in your basis in the replacement property. So the new property you're purchasing remains the same as the basis in your original property. So you could buy a property for $4 million, and the original basis in the sold property was $1 million. You now, when you go and sell that $4 million property, you're now going to recognize a $3 million gain because your basis isn't. I'm going to try to explain this quick to try to answer some questions before they happen. If you were to, let's say you buy a property today for $4 million, your basis is $4 million. But the problem is with 1031 exchange is you're buying this property today for $4 million, but your basis in the original property you bought, likely the smaller property that was worth less money, is now going to be your basis. So again, if your original property had a basis of $100 million, and the new property has a basis of new property's purchase price is $4 million, you're only going to have $1 million basis in a $400,000 asset. But that can be eliminated down the line by using strategies found here, including another 1031 exchange, or perhaps using passive loss strategies. That's something that can be planned for with proper planning. So who should use a 1031 exchange? This strategy is primarily for real estate investors who own real estate individually or as part of a small partnership. LP investors cannot use a 1031 exchange unless the sponsor initiates the transaction on behalf of the entire investor base, because the partnership interests. So when you're a limited partner and a property is sold in a syndication, you can't defer it. You can't defer your gain because it's part of a partnership interest. And B, the entity that owns the original property needs to be the same entity that owns the replacement property. So therefore, the general partnership would have to initiate it for you to work. As a limited partner, you're kind of along for the ride. 1031 exchange and Delaware statutory trusts. So a Delaware statutory trust, a DST, allows property owners to use 1031 exchange to purchase a fractional interest in another, usually institutional quality property that is run by a third party. So think about this. Think about a DST like a syndication. It's usually run by a professional management team. it's a higher quality asset. And the reason why you may do something like this is because the reason why you may use it in exchange is because you're tired of managing property, right? You want to sell your property. You still want the benefits of deferring your capital gains tax, so you can still use that money to invest, but you no longer want the property yourself. So you invest in a Delaware statutory trust instead. The pros of using a DST are you defer the capital gain. You're investing in an institutional grade asset, normally not available to individual investors, and it's a passive investment for you. The cons are the lack of control, and timing can be a problem. I guess I forgot to finish this piece to the side. I do apologize. Timing can be a problem because of the 1031 exchange rules. And one thing to point out here with the lack of control, if you are an investor who's been managing your own portfolio for quite some time, you may not be willing to give up or relinquish your power over your portfolio, over your investment capital. The last one here we're going to discuss today is a Section 721 exchange, an UPREIT transaction. This is a more rare strategy, and that's due to the complexity, but I want to make everybody here aware of it. So Section 721 exchange allows investors to contribute to a REIT in exchange let's you contribute your property to a REIT in exchange for interest in the REIT's operating partnership. So the operating part, so basically what happens is in a Section 721 exchange, you're giving your property to a REIT in exchange for shares of that REIT. That's the bottom line of the transaction. But because where this becomes a little bit more complicated is because many properties don't meet the investment criteria of a REIT. And because of that reason, you can use a 1031 exchange to buy fractional ownership shares of an institutional grade property. So in this strategy, you would be using a 1031 exchange to sell your old property and purchase shares of a DST, which is an institutional grade property that would meet the criteria of the REIT, and then you're contributing your fractional ownership shares to the REIT in exchange for the shares of the REIT. Now, generally, you have to wait about 24 months before contributing those fractional ownership shares to the REIT to make sure basically keep the integrity of the 1031 exchange. And then in this strategy, capital gains are recognized when the shares of the REITs are sold by the investor or the REIT returns capital to the investor. So in other words, in this strategy, overall, you're either doing one or two things to sum this up. You're either contributing your property directly to the REIT for shares of the REIT, or you're using a 1031 exchange to sell your property, purchase shares of a DST, contributing your shares of the DST to the REIT in exchange for shares of the REIT. And then when you sell the REITs when you either sell REIT shares, you're gonna recognize your capital gain, or when the REIT returns, when the REIT basically gives a dividend that is a return of capital. So you're still being able to defer your capital gains over here. So the pros, let's go into the pros of the Section 721 exchanges. One, you defer your capital gains tax. Two, it's a passive investment. Three, something that you really haven't been able to get access to yet with any other strategies, is diversification into institutional grade assets. And it's easier to pass down shares of REITs than it is in direct real estate. And this is for estate planning purposes. The cons, complexity due to timelines, multiple transactions, and timing on the recognition of the gains can often cause this transaction to be burdensome or simply not a viable solution. So now we're going to go into the Q&A section. Oh yeah, and I forgot to say who should use a Section 721 exchange. This is mainly to be used for somebody who has a large portfolio, maybe has large gains in a property. They want to defer, but they want to get that diversification. They don't want to invest in simply one property because in one property they either have to operate with a 1031 exchange, or one property that's going to be through a DST but ran by somebody else. They really want that diversification across multiple assets. And at the same time, it's also used for estate planning, because depending on what you have going on with your family situation, it might be very difficult to leave a direct property to your heirs, or it might be very difficult to leave a DST to your heirs. Instead, you can easily leave shares of a REIT to your heirs. So the Q&A, we do have some questions. Richard Hall says, can't you also carry unused losses back 3 years as well as forward to offset gains? So to answer that question, and this goes back to the first strategy, tax loss harvesting, capital losses can no longer be carried back. That was eliminated with the Tax Cuts and Jobs Act. But they can be carried forward indefinitely. So if you have capital losses, you can use capital losses from prior years to offset current capital gains. But again, you had to have it, harking back to that strategy. You need to always have, at some point, whether it be this year, last year, or in future years, you need to have capital losses in order to use it. So, Richard, you are right, partially at least, on the Tax Cuts and Jobs Act. Unfortunately, eliminated the carryback. We also have another one from Richard Hall. Wow, awesome info. Okay. What are your thoughts on using trusts, especially charitable remainder trust, to defer taxes yet retain operations of some fees and income? I really love trusts, and I think that there's a lot of unique things that can be done with trusts when exiting properties and being able to do it. I just haven't had too much experience doing that just yet. I'm kind of just reaching that point where our clients are really starting to need that. So fortunately, I can't provide too much insight into it, other than to say that they can be very beneficial. Thanks, Richard, for your two questions. So we have two more questions. Okay, no, so we just answered those two questions. Okay, got it. So if anybody has any questions, please feel free to either drop them in the Q&A box or drop them in the chat box. More than happy to go through them. As we kind of wait for that to happen, I do want to, okay, hold on. I think we do have another one in the chat box. Okay, so Brandon just said, please add them to the chat box. So if you have questions, guys, drop in the chat box. Now, that said, until we have questions, I do want to let you know a little about the Real Estate CPA and our services and how you can contact us, learn more information about us. At the Real Estate CPA, we kind of have three core services. The first core service we have is tax planning. Basically, during our tax planning services, we have a multiple call series. The amount of calls is going to depend kind of on your personal situation. But on the first call, we go into a deep dive into your tax and financial related situation, as well as review your goals, your risk tolerance, to really get a very clear understanding of what you have going on personally and where you're headed into the future. Over the next few calls, we answer any pressing tax and financial related questions that you have, any misunderstandings, any topics you need to have addressed. And then we also put together a tax blueprint for you, which contains summaries of what tax strategy, summaries and action items of what tax strategies you'll need to implement in order to minimize your tax liability. There's also a maintenance component to our tax strategy and planning, and that is going to be email and phone support ongoing throughout the year to make sure that you're actually implementing these strategies, and also to make adjustments to these plans as needed. We often recommend that you meet with your tax advisor at least semi-annually, if not quarterly, to make sure that you're reducing your taxes and taking the right steps as early on as possible to make sure that happens. The second offering we have is accounting advisory. Accounting advisory is where we go in and do either one or two things. We either we take a look at your current accounting system and make recommendations or make the adjustments on your behalf to improve that accounting system. Or B, we set up an accounting system for you from scratch, and then we help book any outstanding entries, any previous entries that have not been booked, and then we give you three options. Those three options include either A, we can operate your accounting function for you on your behalf, so you're completely hands-off, or at least as hands-off as possible. We'll still need to interact with you from time to time so that we get an understanding of the context behind your operations. 2, we can train you on how to use your accounting and bookkeeping system. And 3, we can train one of your staff members, whether it be an assistant, bookkeeper, etc. One important thing I forgot to add in about the accounting services, we do use automation. So during that setup phase, or during that that review of your current system, your current accounting system, we do our best to automate as much transactions as possible. Because at the end of the day, you're going to have recurring transactions every month, including rental income, certain expenses you're going to pay every month. But we can automate these transactions to really make the system as efficient as possible, so that either yourself, you don't have to do these entries over and over again, or your assistant, your bookkeeper doesn't have to use them, or you're not paying us to do them for you. So that's the second offering. The third offering is tax compliance and resolution. So we file tax returns. Yeah, I know it's a big service offering here. We'll file your tax returns for you. But we file your tax returns, and we can also answer questions related to your tax returns and provide insights and help you resolve disputes with the IRS or perhaps the state in which you reside. So those are the 3 service offerings. If you're interested in learning more about those, head over to therealestatecpa.com/become a client, and we will go ahead and set up a 15 to 20 minute consultation to discover how we can help you. And the one thing to note about our firm is we just don't take on clients based on their ability to simply pay us. Just because you can afford our services doesn't mean we're going to take you on as a client. We only take on clients who we can actually help. If we can't help you, if we can't add value to the situation, if we can't help you save money in taxes, if we can't streamline your accounting operations, then we're going to tell you, hey, look, it's not the best fit for this time. We're not one of those shops. So there's no risk to have a conversation with you. We love working with multifamily investors. Just the other day, I was able to help one of our clients use a cost segregation study to completely eliminate their tax liability to zero. So meaning they're not paying any tax at the federal level this year, which is truly fantastic, and we love doing stuff like that. Also, you can check out the Real Estate CPA podcast. You can find that on iTunes, Spotify, Stitcher, SoundCloud, iHeartRadio, Google Play. On that podcast, we talk a lot about tax strategies, what tax strategies you can use to reduce your tax liabilities, as well as what other investors and industry experts are doing to reduce their tax liability, or how they handle their accounting and taxes. So again, you can find that out there pretty much wherever podcasts are found. Would love to hear from you on that. If you want to connect with me directly, you can find me on Facebook, Instagram, or LinkedIn. Simply type in Tom Castelli CPA on any of those platforms. You'll be able to find me relatively easily. We do have another question from Richard Hall. Thank you for your question, Richard. I might have missed a portion of this session, but did you mention, or are there thoughts on using self-directed IRAs or 401ks? Some different industry info about their pros and cons, solo 401k versus checkbook control IRA accounts. No, that was actually not part of this presentation, but we do have some time left, so I'm more than happy to discuss that. So here is the overview of using, say, a solo 4. So the best retirement vehicle to use, if you have access to it, is a solo 401k. The reason why solo 401k is the best retirement vehicle for you to use is for a few reasons. A, you can roll over money from a traditional IRA that you have into the solo 401k. You can roll over money from previous employers' 401ks into your solo 401k account, and you can invest it in virtually whatever you want. There's a handful of investments that you can invest in. I think it's, if I recall correctly, it's certain types of alcohol. It's alcohol in general, and certain types of collectibles, stamps, coins, things of that nature are prohibited. But you can invest in anything you want, pretty much, including real estate, and you're not going to be subject to UBIT UBIT or the UDFI on your rental real estate investments. And this is very important for people who are maybe investing or considering making investments through their retirement accounts in a syndicate or into direct real estate, because if you, the best way to describe this is, let's just say the difference between a solo 401k and an IRA is UBIT. That's one of the major benefits of using a solo 401k over an IRA, is that you avoid UBIT. And the way UBIT works is, I'm going to give a high-level overview. I don't want to go too depth into this. It gets really complicated, and but just to give it an understanding, let's say you make an investment in your IRA. Let's just say you invest in a single family property. It's a $100,000 property. You put 25% down. So you put $25,000 of your IRA money to purchase the single family house. And then you use 75% of you finance the other 75%, the other $75,000 with a loan for the bank. Because 75% of your property is being financed with debt, in an IRA, it's called, that part of the income from that debt financing is called UDFI, unrelated debt finance income. And you are charged a tax. You're charged the unrelated business income tax, UBIT, on the portion of income considered UDFI. So in this case, to give a quick example, so just to use a quick example for this, if you if you were to use that same property you purchased for $100,000 and it would have net income of $10,000, you would have to pay UBIT on $7,500 of that $10,000 of $7,500 of that $10,000 in income, because that part, that $7,500, is attributable to debt financing, and that is taxed at the trust tax rates, which scale very quickly to 37% after just $12,500 of UDFI or other income that's subject to UBIT. Good news here is your first $1,000 of UBIT is exempt from taxes, and also because as we discussed before with the passive losses, oftentimes depreciation causes a loss large enough to shield the income from your investment from tax completely. So really what you see is on the back end, you'll really see UBIT in an IRA on the back end when you sell it for a capital gain. Generally at the time when the property is sold, it's still being financed with debt. There's still a portion of that property. So basically what's going to happen is a portion of that capital gain will be subject to UBIT, which is generally where we see it. Now, the good news here too is that from my experience, at least from all the calculations I've ran in my career so far, that the UBIT generally only hurts the IRA's return, the IRA's investment in a syndicate or in direct property by 1% to 2%. So if you're able to get 10, 12, 15% on your investments, taking a 1% to 2% hit to invest out of your IRA account isn't too bad. Matt Norton asks, what about beneficiary IRAs? I'd have to take a deeper look into that, but I'm pretty certain because it's an IRA, the UBIT rules also apply. So just to kind of recap what I just said there, I know it was a lot and I don't have any slides on it. Solo 401k is the best retirement vehicle if you're going to be investing in alternative assets because you avoid UBIT. IRAs, still good vehicles to do it, but you may be subject to UBIT if the properties are financed with debt. So with that all said, the best investments to make out of an IRA, if you're going to invest in an IRA and you want to invest in real estate, invest in notes or note funds. So in other words, become a private or hard money lender and lend money to other investors, because that interest income will be shielded from taxes with the IRA. It's not subject to UBIT. Or if you're going to be making investments in syndications, try to do it through a solo 401k. As for checkbook control, that is the benefits right there. The benefit is the avoidance of UBIT versus solo 401k, and also the same thing with a solo 401k. You also have more ease of use to invest your fund, more discretions over it. Whereas most of the time with a traditional self-directed IRA, unless you have unless you have checkbook control over your IRA, you have to run everything through your custodian. But that can be eliminated with checkbook control. But there could be some issues in there as well that you want to talk about with your CPA and an IRA custodian. So that all said, we have another question from Brendan Abbott. How does an EQRP compare to a solo 401k? Brandon, quick question, just a clarification on that. When you say EQRP, is there, could you just remind me what the E stands for in the QRP? I'm going to take a quick look at it right now. An EQRP, just to clarify here for everybody, an EQRP is, hold on, give me a second. An EQRP is a self-directed 401k. So a QRP, so basically what a QRP is at the end of the day, a QRP is an employee is a retirement fund that is provided by an employer. A QRP is pretty much any type of fund, any type of retirement account under Section 401. So it's a 401k. A solo 401k is a QRP. They are one in the same. Is a solo 401k any different from a 401k you get from an employer? Great question. A solo 401k. So a solo 401k is a retirement account you have when you're self-employed. When you have a retirement account from a traditional employer, say you work for a corporation or you work for any type of business really that offers a 401k, that's provided directly by your employer. They control the plan. They control what is they go to a provider. They pick a provider. Let's call it a Guideline or maybe a Fidelity or a Vanguard or whatever the custodian is. They provide it to you, and you have the option to invest. You can invest up to $19,000 on the employee side in 2019. The difference with a solo 401k is it's in your control as a self-employed individual, meaning you either own a business or you have 1099 income. You can set it up yourself. You can contribute up to $19,000 on the employee side. But the real benefit of a solo 401k is you can also invest on the employer side. You can invest up to another $37,000 on the employer side, depending on what type of business you are, whether you're a sole proprietorship or you're a corporation, will determine how much you can invest of that $37,000. I believe off the top of my head, for sole proprietor, it's 20% of your net income, roughly. If you're a C corporation or an S corporation, it's going to be 25% of the W-2 wages that you pay yourself. So just to recap that there, solo 401k, you control. If you're self-employed, you're eligible for one. You could do an employee contribution as well as an employer contribution up to $37,000 for a total of $56,000 in a single year. So that's the main difference. Hope that answers your question. I think it did. Done. Okay, so if anybody else has any other questions, I will be here for a few more minutes. If not, I hope you enjoyed the presentation. I'd love to hear feedback from you if you want to email contact@therealestatecpa.com. I'd love to hear what strategies you would like to hear about in the future for future things. Okay.
All right, Thomas, I appreciate that. And great content as always. So many people have questions about, there's so many different options and so much different advice out there. It's hard to kind of sort it all out. And again, like we started off, it's important that you get advice from somebody who understands the field that you're in. So some CPAs are they'll be like, oh, no, don't do that. But they don't understand where you're coming from, right? Or where your money's at, or, 1031s or cost segs. And so it's important that your CPA understand, what you're doing. And so that's why it's very important to, if you guys are looking for a CPA firm, especially if you're a syndicator, you've got to have somebody on this, especially like Thomas talked about, bringing the cost seg into the tax return portion. So, your cost seg is done by your tax engineer, but not all firms do the next portion, which is bringing the K1s and the basis and calculating basis and tracking the basis, because you have to track your basis is reduced each year you're taking a loss. And so you have to track all that every year for every property.
Yeah.
So all about that. You know more about that than I do. So
I just throw something in there. I have a few recommendations for people out there. If you're going to be looking for a CPA, make sure they have real estate expertise. Doesn't have to be us. Could be anyone. Just ask them, how many real estate clients do you have? How long have you been working with real estate clients? Could you give me a reference to one of your real estate clients? Do you work with syndicates? If you're going to be, investing in syndicates or running a syndicate, make sure they have that experience. The second thing is, like what Brandon's saying, the basis is super important that you track on your partnership, on your tax returns. I've seen it so many times. We receive K1s from other CPAs or K1s from clients who had a previous CPA before us, and the capital accounts are all out of whack. So that's something I'd often recommend as an investor, that you track yourself ask your CPA how that works, how the basis does it. And I give you the overview real quick right now. Your basis is going to be increased by your capital contributions. It's going to be increased by your income, by any income. It's going to be decreased by distributions, and it's going to be decreased by losses. So those passive losses do decrease your basis in the partnership. Now, if you're a general partner, you can also increase your basis by signing on the loan. Debt will also increase your basis in a partnership. Taking on debt, usually as a limited partner, that's not going to impact you at all, because again, you're not taking the risk of taking on the loan. So that's a high level overview of how that works. I would definitely discuss that with your CPA and also track it yourself.
Excellent. Yeah. Very important. Like we said, you can miss out on a lot of benefit that way if you're not doing that correctly. And not all CPAs are created equal. So, all right, Thomas, we appreciate you joining us so much. Again, I know you joined us in January and again for this summit, and we always enjoy having you and appreciate the contest attendees. Make sure you reach out to Thomas if you're looking for a good CPA. They are going to vet you, make sure they can add value to you. I'm pretty sure that they'll be able to do that. So be sure to reach out. He's provided you with all the information, and be sure to download this video later. If you didn't catch all that, listen to it again, watch it again, and catch all that information. So
absolutely. I want to thank Brandon. I want to thank you. I want to thank Stacey. I want to thank Dan. I want to thank everybody on the MFIN staff for having me back. Really enjoyed it. Really appreciate it.
Well, thanks for being with us, Thomas. Have a good rest of the day.
You too. Bye now.
All right, everyone, thanks again for watching with us. We have coming up in the next session, we have a tag team session here. They're going to work together. These are partners. Vina Jetty and Neil Dandona are going to talk about 6 figures in 6 minutes. So that sounds exciting. Be sure to tune in at 3:30 for that. Claim your share of 10T. Yes, trillion, that is. This is the title of that. No, sorry, that's in room 3. That's the next one. But asset management is with Vina Jetty and Neil Dandona. Apologize about that. I was reading it wrong. So in room 1, we have panel discussion, top negotiating tactics with Omar Khan, Charles Dobbins, Brian Burke, and Matt Faircloth. Room 2, again, we have asset management with Vina Jetty and Neil Dandona. 6 figures in 6 minutes, claim your share of the 10T, yes, trillion. That's with Dan, I can't pronounce that name, Grisels. So I apologize about that. So be sure to sign up to win a iPad. We have 3 of the iPads to give away. There's 3 ways to do it. And really encourage you, make sure you go and give a podcast review. Help us out with that. That's all we're asking you to do. And simply for doing that, helping us out, it takes very little time. Give a review, send a screenshot to Stacy at multifamilyinvestornation.com. You're entered to win an iPad. How easy is that? So just go ahead and do that. Knock it out right now. Take action. And make sure you register for the next summit while there's still spots available. That's nextmfin.com, and participate in as many rooms and chats and questions as you can, and we'll be tracking all that for entries to win. So we'll see you again in a few minutes at 3:30.